Hello, everyone. Today on the final bar, we're going to talk about September following through for its reputation for being a destructive month seasonally for stocks, with the S&P really rolling over, down over 2%, really selling off into the close. We've talked a lot about just this relative weakness, the internal weakness, the breadth conditions coming out of the previous highs. Days like today certainly feel like the potential for further downside is very real, worth paying attention to. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the activity in the markets, try to make sense of an environment of increased volatility, of increased uncertainty, and with certainly lots of sudden movements back and forth. Yesterday sort of felt like a bit of a recovery day, but the challenge with a downtrend, which I would argue we're at the very least tactically in a new downtrend here. The challenge with downtrends, you will have up days that feel like everything's kind of all rosy once again, and days like today following through in the direction of the primary trend, for me, certainly suggests that there's further strength to the downside as levels start to be broken. We pay attention to it. My guest today, Leslie Jouflas, has a great long-term chart trying to put this move into proper perspective. We're going to start long-term and look at the big picture and how this last week or two, this last couple weeks really fits into that big picture trend. So excited to hear Leslie's take on what we're seeing today and elsewhere recently. I did want to point out Leslie is a fantastic guest today. We have many other great guests coming up on the final bar. Tomorrow, we have Todd Sohn joining us from Strategas Research Partners in New York. Back to the show. Next week on Tuesday, the 29th, Jonathan Krinsky from Baycrest Partners. On Wednesday, John Kosar from Asbury Research. And on Thursday, Guy Cerundolo joining us the first time from Cerundolo Research. I worked closely with Guy at competing firms in the Boston area. He was an analyst at Wellington Partners for a number of years and has his own firm, does a really good job, and is followed by a lot of good institutions. So it should be fun to get his take on things right about now. Also, if you missed it, we had a fantastic time yesterday morning with our special event introducing StockCharts ACP. It was wonderful. We had conversations with John Murphy, Martin Pring, Larry Williams, Ralph Acampora, Mish Schneider, Dave Landry, Arthur Hill, Grayson Rose, and Chip Anderson, and I from the StockCharts team had a lot of fun sort of sharing the benefits of this new platform we've created, ACP, including the ability to trade stocks for free directly from the charts and a low-cost monthly options trading setup as well. So if you missed that, check it out on our YouTube channel. There's a lot of really cool content in there, and the conversations were just great about how technical analysis has evolved from some of the really true masters of the craft. Let's get to our market recap here. As I mentioned, today felt like a follow-through day to the downside. I didn't quite look at the breadth measure just yet, so let's kind of go right to there. I tend to look at percent of advancers decliners just on price. My friend and mentor, Walter Deemer, swears by looking at volume. So he'll look at up volume and down volume every day. I'm sort of used to looking at advanced decliners based purely on price. As we process the closing values, this might tweak a bit, but it's right about a 90% down day by my read. It's 89%. I tend to think a little loose with it. So if it's 89, that feels a lot like 90% to me. So I'm going to call this a 90% down day, which basically that doesn't tend to happen in a bull market phase. That is more characteristic of a bear market phase. You see that here from mid-February to really early April. You saw this cluster of 90+% down days, which just showed everything was down. It wasn't just a small number of stocks with people taking profits. That's more of a heavy move on one side versus the other. So worth noting, one of the question marks during this pullback is you haven't had the huge 90% down days, the huge sell-off where everything's going down. Today, arguably, is the closest we have had to that. And I would say it's enough for me to call that a bear market sort of move. In terms of what happened here, let's look at the movements. Let's look at some of the charts and see what we can find. So the S&P finishing down to around 3237, just below that. That's down over 2.33%. The NASDAQ 100 down over 3%. Mid caps and small caps, all about the same. Small caps were down the most, down about 2.8%. So, certainly a broad-based move to the downside. All 11 S&P sectors down. The ones that were down the least were healthcare, consumer staples, utilities, pretty classic defensive sectors to go into. What dragged us down the most was energy. And it's interesting, oil prices were not down dramatically. They're actually kind of flat for the day, but energy really got hit. So it shows you it's not just the price of oil that's causing energy to go lower. Tech was number 2, and obviously looking at the big names like Apple and Alphabet and others to see how they are performing, if they're able to hold up. And again, just based on what I'm seeing and the momentum shifting, it certainly feels like we're going away from tech at the moment. Followed by materials, which overall has been a pretty strong relative performer, but precious metals down pretty good today with the GLD down 2%, silver down over 7%. So we're really retracing around that range that we had set previously. Bonds essentially closed today flat, although they had opened down and rallied really to close more in the positive. So the only thing really on the positive side of the ledger, the dollar and bonds really is that's about it. Let's get to the chart of the S&P 500 here. We're updated. What we looked at in the last couple of days, we sort of talked about this 3350 to 3400 level. That was the very first level. As long as we could hold that, even the tactical time frame is positive. We've now broken that pretty consistently. We've now broken the 50-day moving average, which is sort of strike 2. And as we're coming down, the good news is you can use a trend lines from the previous low. So the low from the highs. The high just below 3600. The secondary peak we made here about a week ago, and now we're sort of tracking this lower. So when we rallied yesterday, my thought was, all right, as long as we remain below this trend line, and now the tactical time frame still remains negative, and today obviously taking us further away from the trend line, sort of confirming lower highs, lower lows. The short-term trend is down. Now, everyone that I know from a technical perspective is keying in on this blue shaded area, which is right where we closed today, right? So it's around 3,200 to 3,250. There are plenty of levels within there which you could pick, but I think for me, that's sort of the main, area you'd be looking for. We're there. And so the question now is, are we able to hold this? Are we able to hold the low from the end of July, or do we break this? And then you really have to start looking a little deeper. And I would say the next one's around 3050, which would be, we're now getting down into that congestion area off of the June highs. This is the 38.2% retracement if you take the March low to the September high. So certainly I think it is reasonable at this point, if you're not doing it already, to be thinking about potential downside objectives, looking for opportunities that may arise as we reach some of those levels. The RSI is now below 40 on the S&P, which again is more characteristic of bear market phases than bull market phases. Now, one of the key charts we've looked at, going to the Mindful Investor Live chart list, is this one, which is looking at the cumulative advanced decline lines for the different cap tiers. And they've already turned negative for common stocks, for mid caps, for small caps, as these now have gone in downtrends. The one holdout was the S&P advanced decline line, just testing it yesterday. This is not updated for today's close. 100% certain this is going to be below there, which means if we remain around these levels on Friday, when I change the color coding, if necessary, I'll turn that one red, and we have all the breadth indicators turning tactically negative, basically saying breadth is confirming a downtrend. So by my read, I think we're at that point where you consider this. You assume that this is going to rotate lower until proven otherwise. Now, the one, the thing to remember is differentiating the tactical time frame to the long-term time frame. And as I'm looking at the long-term model, one of the things is this medium-term trend model, which is using the weekly MACD. Depending on where we close this week, we might actually register a sell signal. So that remains to be seen. Looking elsewhere around the markets, just in terms of movements, very few industry groups on the positive today. Footwear was the only group really up significantly. This is Nike, which gapped up a little higher. We're going to look at that stock a little later. We have a segment called It's All Relative. We're going to focus on relative performers. That, the gap up on Nike was certainly a nice positive surprise for the stock. That, the trend has been positive up until this week. So I don't think that's a surprise that the trend is positive, but certainly gapping higher when most things are not. On only two other groups, one within consumer discretionary and the trucking group inside industrials, that have managed to be positive. Pretty much everything else on the downside. But What is worth paying attention to, and again, I don't want to get too much into the relative stories, but we can go there because here we are. If you look at on a down day, it's always interesting to me to see what is actually managing to close higher, but also what is not down so much. And if you look, a couple sectors are represented here, heavily industrials, right? So heavy construction, delivery services, which is like FedEx, UPS, and others, and then trucking are all, you know, flat to up to down just a little bit, right? Sort of right around zero. And so on a day when the S&P is down 2+%, when a lot of sectors have really struggled, groups that are able to hold up tells you that that's where you might want to, you know, think about hiding out. Pharmaceuticals is another one. We've not talked about the healthcare group a ton. And if you ask me to pick a chart that I'm, you know, it's not the most beautiful uptrend that I've ever seen. But again, at a time when a lot of stocks are, a lot of groups and a lot of stocks are breaking down significantly, it's not in a horrible, you know, it's still in a short-term downtrend, holding above its 200-day, but the relative strength is starting to improve. And what would tend to happen, what could happen, is you have a group like this, which still trades lower, but not nearly as it doesn't get hit nearly as hard as some of those other key groups. And when you think about having an equity allocation, you probably need to be there in some way. And so the trick is, you know, gravitating toward things that are working. So what are the groups? What are the ETFs within the equity landscape that are actually starting to work? Looking at non-US markets, just very briefly, we talked about China yesterday and highlighted the potential breakdown that we saw in China, or not potential, I think it certainly has happened. Worth noting, Japan is the only one of the ETFs in the universe that I track of global ETFs that is positive for the day. And again, it's actually in a pretty good uptrend, higher highs, higher lows, which is worth paying attention to. The RSI has remained above 50, which is compelling, and the relative strength really emerging in the month of September. So, you know, in this sort of environment, I would be focusing on this line at the bottom. Most things are going to be down. Focus on the things that are able to outperform, and you're going to cushion your downside potential and stick with groups that are actually holding up. And Japan might be a really interesting idea in terms of something that's actually able to work on a day like this. We need to take a quick commercial break. We'll be back with my guest, Leslie Jouflas. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to remind you, we'd love to hear from you, in particular questions you're running into as you analyze your charts. Hit us via email, thefinalbar@stockcharts.com, on Twitter, @FinalBarSCTV, or just put a comment below any of our content on a place like YouTube. We're going to gather all those questions and hopefully answer one of your questions in our next mailbag segment at the end of this week. I want to welcome on my guest, Leslie Jouflas. Leslie is a fellow Seattleite, I guess we would call ourselves, in the area, and runs Trading Live online. Has done a fantastic job with one of our sister shows, Your Daily Five, has gotten fantastic reviews as a result of that. So Leslie, thanks so much for coming on the show today.
Well, thank you, David. Thanks for inviting me back. I think it was last February that I was here just before the February decline in the market. So the timing of this is interesting. I'm going to show you today this broadening top pattern. This is a monthly chart. So we're looking at a pretty long time frame on this. So I want to bring your attention with these patterns. I put some references up here that you can look up that I've also used with this pattern. All of the material from any of these forefathers of technical analysis are just fantastic to read about. But H.M. Gartley, in his 1935 book, he defined the broadening top market and talked about it there as one of the major reversal patterns. And he says that it usually forms the end of it in the whoopee state of the market, when there's just a lot of excessive speculation in the market. And Schabacher also talked about it, and he credits A.W. Wetzel with first mentioning this pattern. He has a book from 1934. You can find copies of it still. But it has at least 5 reversals, and rarely it'll have a 6th reversal. So I've got the trend lines. It's a reverse triangle drawn in, and we've come up, it looks like, to a completion point on this pattern. And with the price action that we're seeing currently, that fits in with that. It is, however, possible to still have another little jiggle to the upside, and this pattern would still be intact. But we can see here that the market on a monthly basis is forming a very bearish candle. We still have a ways to go to close, but the last couple of days have been extremely bearish. So we'll want to see what this looks like at the end of September. But what we want to be watching for right now is we want to watch to see how deep this correction goes to the downside. David just mentioned a couple of levels. The key is going to be the retracement back up after the market finds some support. That is going to be the key area. If we come up and fail to reach a new high and then turn to the downside below where that support was, then we may see a stronger move even heading back down towards these lower trend lines. I don't want to be the bearer of bad news, but we do want to watch to see if the market is unfolding in this way. It only helps us to protect what we have and look for some potential buying opportunities. Then this downtrend line at the bottom is going to be extremely important to watch for support on that. Now, the other thing I would like to show you today is I'd like to show you a chart, an intraday chart of what I was seeing at the highs of that monthly chart before this decline started. There on the RSI here, we can see there really was no clear divergence. And I noticed that on David's chart that he showed of the daily SPX as well. But there really was a divergence on here that you could have spotted. So the blue arrow is showing us that RSI high. The red arrow is the next day where the market made a slightly higher high, and that's where this divergence is. The RSI failed to come up with that higher high. Now I have some support lines marked in here, and you can see the RSI breaking through the support lines. The dashed line is showing us some important support that was going back into August, and it clearly broke that. It had a small pause where the red arrow was, and this is an important signal here on the RSI when it failed to be able to come up for air and then turn down and broke the rest of the support. We can see gaps in this chart right around those highs. That is not a good sign. There was no attempt to fill that gap. And then the gaps over to the left, you can see the long bars that went right through that gap. That also is not a good sign. So the market then declined into for a couple of days, the early part of September. And this pattern is one that we tend to see as the first retracement pattern in a new downtrend. So this is a Gartley 222 cell pattern, and that formed and completed. And then from there, we pretty much to the downside. And I think we'll get down to some of these deeper retracements now that David was showing on his charts.
That is such a great take, Leslie. I wish it was a more optimistic take, but I think it's a realistic take on what the weight of the evidence is. And I appreciate you sharing, especially as the market rolled over there in the beginning of September, an interesting signal in the intraday chart that I certainly didn't see, illustrating some further potential weakness. Leslie, thank you so much for coming on the show. Wish you the best, and we'll look forward to having you back on again soon. Okay.
Thanks for having me back, David. Thank you.
That's Leslie Jouflas from Trading Live Online. And again, starting with the broadening top pattern, which, again, that is a very valid take. It provides a pretty steep downside potential target if you think about, completing that pattern. And again, whether or not you see S&P 2000 as a reasonable downside objective, the fact remains we're at the upper end of this pattern. I think, getting down even to the midpoint of that is totally reasonable given, the history of that pattern. I'm certainly going to want to dig into some of those the required readings or the recommended readings that Leslie provided. Our next segment is called It's All Relative. So in an environment when the market's starting to struggle, right, the question is, where do you go? What do you do? And, I think question number one that you want to answer is, how do you manage risk within your portfolio, your clients' holdings, whatever it is, that universe that you are responsible for, making sure that you are sticking to a plan to limit downside losses. But the question is, where do you go? And even in a down tape, you most likely are going to have some equity exposure of some sort. And the question is, what do you do? And it's all about getting defensive. It's all about trying to identify where the opportunities are. Now, as a trend follower, the goal is to, of course, lean into what's working and lean away from what's not working. And in a down tape, ideally, you're able to find things that are able to still appreciate. And I think that's obviously question number one. But given everything going down, where do you try to hide? Where do you try to weather things like that out? So I'm going to give you just a couple, just a couple ideas, and then let's look through some individual charts of some certain stocks that are actually still holding up okay on a relative basis. The first thing I would think to look at are stocks that are able to rally. So looking for new swing highs. So screening for stocks making new 13-week highs would be my first question. And so, in our scanning engine, I have regular screens for ETFs making new swing highs, S&P stocks making new swing highs. You can replicate that screen for any universe. And again, the challenge is just finding stocks or ETFs that are actually able to hold up and appreciate and made two swing highs. And you can tweak the time frame if you want to. But that's the first thing that comes to mind. The second thing is look for improvement in their scooter rankings. And so this is, again, just a quick version. You could go to our scooter report page to get a deeper list of names that are starting to work. But these are just from yesterday's close to today, which stocks were able to improve the most on their scooter rankings. So the number one stock that was actually able to improve was Under Armour, UAA. Now, what's going to happen, I'll tell you, having looked through these names ahead of time, the challenge that I have is a lot of times the stocks that appear on the most improved list are things that are beaten down a ton and are bouncing off of some pretty depressed levels. So I would certainly never suggest you just blindly take a list of stocks that are improving there and consider that to be a good list. I would say that's a great list to start with, and then review the charts and start to identify them. What's interesting about a chart like Under Armour, when you think about the actual, the average stock, which looks kind of like Apple, where you've gone up pretty significantly, you're now breaking, recent support, you're making lower highs, lower lows, starting to rotate lower. Under Armour has actually had this broad rotation from distribution really into May. It sort of bottomed out in March when the market did, but then continued to remain depressed while everything else was kind of rallying, and that's why the relative strength was so bad. It's remained essentially sideways because it's a pretty low price name under $12 still. And so, these moves are big moves, but overall it's been relatively sideways. We can see that the picture is starting to improve. Higher highs, higher lows at a time when the average stock is not doing that. So looking at names like that are in more favorable price structures could actually be a really compelling opportunity. So again, finding things like that, it's all about starting with the scooter reports, looking for things that are up the most. And what you can do is either start here. The other thing I would say is go to charts and tools, go to the scooter reports. What you can do is actually go to even a longer period of time. So set the universe, large, mid, small, whatever. Sort it on the stocks that are improving over the last week. And this will tell you things that are starting to rotate up a little bit, things that are holding up when other things are starting to struggle. And that could be an interesting list of names to sort of go through. These are stocks that are most likely outperforming. Now, what I did is just with a combination of those two things, and then through my normal process of looking at a ton of charts, I came up with some random names to kind of go through. We talked about Nike having the gap higher today. And again, it's up over 8% on a day when the S&P is lower. It's overbought again, which it's been overbought recently. The relative strength, though, has been positive. This is today's jump that shows you that it's popping higher, but it's been making new relative highs in the last week for the last 12 plus months, right? So, if you look at the last 12 months, we've made a new relative high this week, not just on today, but leading up to today. So this pattern of higher highs and higher lows has been in place, even as other things are starting to break down through recent support levels. So things that have not broken down through support, like Nike, even though it's up a little bit, I don't think that's a bad idea. Twitter is another one that's certainly rotated more to the positive side. You can see the relative strength again. It's up pretty good today, up over 6%. That's not what excites me, though. What excites me is this part leading up to today, right? This was yesterday on a day when the market sort of, flat up a little bit. Previous day when the market's sort of, struggling to turn off and turn up from a recent pullback. And this is just hammering out a pattern of higher highs and higher lows above an ascending 50-day moving average. It's not a bad chart. it's not local to just these couple sectors. So other things that screen pretty well on relative improvement stories. Merck is an interesting one. And what doesn't excite me is just we're sort of in this, sort of consolidation. We're sort of making lower high, a lower low. We're holding the 50-day moving average. That's good. The RSI remains above 40. That's good. What most impresses me, though, is a new 3-month relative high as it's rolled a little bit higher. So holding some of those key support levels, the relative strength improving. We talk about pharmaceuticals as being one of the stronger groups today, not down as much as other things. Walmart is not my favorite price chart only because we really rallied into the September high, came off of there. But again, it's above its 50-day moving average, which most stocks are not. The RSI is right above 50, which is higher than the average stock. And the relative strength, again, making a new 4-month high this week. Continuing, and you can tell there's sort of some defensive blue chippy types of names in here. And I think that's kind of what makes sense if you look at the large cap universe. Procter & Gamble is another one that holds up okay. Again, on a price basis, hasn't come off too much. Just down, 4 or 5 points from its highs. The relative strength is what's most impressive to me. And again, it's pulling back a bit, but overall, it's holding up really, really well. So in terms of an opportunity to weather the storm, it might not be a bad idea. L Brands, again, which is it's crazy because you think about back here when it felt like it could potentially go to zero. It was beating the market on the way down to the March lows, but since then, look at how the relative performance has actually been consistently pretty good. And even though, again, it's down a little bit today, overall, this trend remains fairly constructive with an RSI above 50. So, consistent themes with these charts that we've started to look through. A couple things. Number one, the price, as much as possible, ideally making a primary uptrend, higher highs and higher lows, above an upward sloping 50-day moving average. That would be good as well. An RSI above 50, or at the very least above 40, would put it above most stocks at the moment, especially above 50, and the relative strength line improving. If you can find charts with that combination, I think you're going to feel at least a lot less bad about the downside potential of a portfolio, because you're in things that are actually holding up pretty well. I did want to finish up and just look at the chart of Apple. So, when you think of the Apple chart, let's get to the one I just saved earlier here, just the Fibonacci lines on here. When I'm looking at Apple, again, there are plenty of stocks that are breaking down. There are plenty of challenging levels to be focused on. With a stock like, if I've had one stock to look at, Apple might be it. Because if you take the low from March, the high from the beginning of September, we've talked about this Fibonacci support level right around 105. If Apple breaks 105 significantly, if it follows through, if the RSI breaks below 40, the relative strength continues to roll down. I think one of the high-flying names for this uptrend starting to really underperform, and you have to just get defensive or start thinking about potential downside. And on a move like this, it's all about what downside potential you're comfortable with, and I would be prepared for a move down to the 200-day moving average around 85. That's the next Fibonacci support level as well. That's our segment. It's all relative, focusing on relative outperformance. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is using traditional Dow theory. This is the Dow Industrials and the Dow Transports. It's a bit controversial in terms of how relevant this still is. This is the combination that Charles Dow created 100 odd years ago using the Dow Industrials and the Dow Railroads. The concept is using the same combination. It's worth noting the industrials have broken down through their recent swing low. Transports have not quite done so. Transports as a group have done very, very well. And that includes, shipping and delivery and all of that. But you can see it's close to breaking down through a recent swing low. And again, whether or not that gives you a primary sell signal from the Dow theory is less important, but I'm just recognizing the fact that the trends are lower. Here we have what I call the new Dow theory. And I think it's worth noting that both the S&P 500 and the NASDAQ composite are now below their 50-day moving averages for the first time since back here. The last time you saw them both above for an extended amount of time and we rolled over was the last week in February. We know what happened after that. Third chart is industrials. Talk about relative strength. And industrials, again, have pulled back. They pulled back to a 50-day moving average. Materials are in a very similar configuration. My question is, are they able to hold their ascending 50-day moving average? But I still like the sector on a relative basis because it's holding up pretty well. As long as that holds up, I think you see other sectors like technology, consumer potentially rolling lower. Stick with the sectors that have worked. Folks, that's our show for today. Thank you so much for joining us for the Final Bar every weekday after the close. Special thanks to Leslie Jouflas from Trading Live Online for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.